All right, guys, here we are, 6/9/26. It is another Tuesday, and we are looking at what's happening in the mortgage-backed securities and what's driving the interest rates, because that's exactly what everybody keeps asking. It's probably the most common question I've ever gotten in my career when you start a conversation with anybody about buying a home, financing a home, getting an investment property. What's the interest rate? Um, well, we're going to talk about what that is, as we always do. But first, before we get there, if you don't have it, grab it. Also, when you go to the website, quitjerkingoff.com, you can download these. You can download the actual ebooks for these. You don't have to buy them, but if you want to, buy the damn things, because why not? This right here, shot right there. Right there's where the picture was taken for this. And I even have the hat hanging on the wall and the shirt. Then you've got also, this was taken right outside here. So, and if you're looking at this is in the cabin next door. So, which is the office. That's it on the outside. This is from the inside. This is from the doorway. So, a lot going on in this place. This place has had a lot of, it's been a spot for a lot of, how do you want to put this, just imagery for what we're doing here with the Red Economics series and the Quit Jerking Off Initiative. That was the other 4 books. And there's 4 more that will come out eventually. And I'm also working on a whole other book. Got chapter 1 about fleshed out, and I'm working all the outlines done. I'm working all that with respect to everything that I'm doing for my family and trying to help you with your family and the future of your bloodline. Ultimately is what we're doing. So let's take a look at what's going on in the market today, because we'll cap a little bit about what happened on here on Friday, and we'll touch a little bit of what's going on today. So you're looking at the market still taking that beating. Now it's going back down into this channel. If you look, this channel, we can actually extend it out a bit now. Put it right back down in here. It's going to land right there, is about where we had it, I think. Right there. Yep. So we're down in the channel, deep into it. I'm gonna go ahead and save that viewpoint. But what happened, right? Friday morning gave us a reminder that good economic news is not always good news for mortgage rates, right? The stronger than expected jobs report shifted the bond market into thinking expected jobs around 88,000, actual jobs 172,000, unemployment rate remain near 4.3. The market reaction is the economy is possibly stronger than we thought. So why would the Fed rush to cut rates? Now, if the Fed cuts rates, that means their costs are going down. So when their costs go down, they could take a little bit less in the return on investment, such as a bond like this. So what happens inside that trade? When a borrower locks a mortgage, they're stepping into the bond market. Their payment becomes the return that somebody else is buying. And after Friday, investors basically said, if inflation risk and economic strength remain, I may need more return to commit my money for 30 freaking years, right? The investor is going to demand higher yield. The existing lower yield bonds lose value. MBS prices decline. Mortgage rates will move higher. Friday was a reprice event. The bond market moved from maybe the Fed cut sooner to maybe the rates stay higher longer. That 10-year pushed up, closing around, they said the 4.5 range. Mortgage-backed securities pushed down, as you can see right here, pushing that to a point where we're going to get a little bit more of a higher rate. After that, large soft sellers, traders often look for buyers to step in, and they didn't really step in because the market wanted more evidence. The next question became, is inflation going to cool? Are oil prices adding pressure? Will the Fed remain restrictive? So what does that mean for you guys? You're basically trying to trade off and decide, am I going to stay? What do I need to have? Am I going to stay in this deal for long enough? Is it going to give me the return I need for the interest rate that I'm willing to pay? Well, of course, the bond trader who's putting his money out there saying, is that going to be enough return for me to justify holding that potentially for 30 years with what's going on in the market today? What does that mean for the market in the future? Is it going to be something that's going to cost me more money to hold that money? So there is a little bit of a tug of war. But here's the cool thing about it, guys. When it comes to a 30-year fixed mortgage, it's just a one-way bet. You're the one who wins in this. Why? Because you get to lock it for 30 years, and you get to decide when to exit that trade. The bond trader who bought into that, they're stuck. You're in it, and you can decide when to pay it off. You can refinance it, you can sell it, you can do all these different things to get them out of it, but they got to wait for you. So here's the thing. If the rates go up, you're protected for 30 years, and that bond trader, they're stuck. If the rates go down, you can get out of it. You can get a lower interest rate. You can refinance if you want. You can sell that house. There's a whole bunch of other things you can got. So ultimately, you're the one who's most protected in this deal. So if you're sitting here waiting to see if the rates go down, should I wait and see if the economy gets better? Should I wait and see if the market gets better? Should I see if the rates go down? What happens if the rates go down? Prices of the houses go up. You will still pay for it one way or the other. So you might want to just lock it in now when the prices of the houses are lower than what they're going to, the way they might be in the future. Now, there is a lot of talk of a lot of potential FHA foreclosures coming up. I don't know. Some of those markets are not markets where investors are at anyway right now. So those are things to look at, but I really believe get something that you think you can keep reasonably rented for the entire time you own it. You can raise rents. It can appreciate. And let's talk about this for a second. You buy a $200,000 house, right? You put 20% down. How much is that? $40,000. You have a $160,000 loan that somebody else is paying off. Do the math. 160,000 divided by 30, because it takes 30 years for your tenant to pay that off. That's $5,333 per year. You put 40,000 down plus costs. Let's say it's 50 grand. $5,333 is equal to 10.8% of what you invested of 50,000. Even if it's as high as 50, it's probably going to be somewhere close to 46, 47,000. Now let's say a property appreciates at 2.5%. It was 2.5% of 200,000. It's another $5,000. $5,000 and you invested 50. That's at a max 50. That's another 10%. You're at 20.8%, almost 21% before any cash flow, before any tax benefits. Come on, guys. This makes sense. Any questions about this? You want to dig deeper? Reach out to me. We'll talk about it a little bit more. Appreciate you. Talk to you on Friday.